Hello, and welcome to Credibly Challenged, a podcast about bank risk management. My name is Matt Bisanz, and I'm a partner in Mayor Brown's regulatory practice. With me today are Amy Kvien and Jim Scott from the Ceres Accelerator for Sustainable Capital Markets. For today's episode, we're tackling a topic that's not only important for financial institutions, but the entire planet: climate change risk management for banks. Climate change is a reality that's impacting economies, industries, and communities worldwide. Banks play a crucial role in the global economy, and they're not immune from the impacts of climate change. Therefore, I'm so happy to have two experts joining us today from this field. Jim Scott is the Senior Advisor for Financial Institutions at Ceres. Jim is an expert advisor in financial institutions and regulators on opportunity identification and climate risk management best practices. He has extensive experience in the banking, capital markets, and sustainability fields, and has addressed audiences worldwide on topics at the intersection of finance and sustainability. Amy Kvien is the manager for financial institutions with Ceres. She works with banks and financial regulators on climate risks and opportunities. Before this, she worked for the Federal Reserve, including time spent on climate change for the Federal Reserve Board, where she co-authored a paper on what large global banks are doing about climate change. And that's how I ran across Amy and thought about inviting her on this podcast. So it is getting some note there. Jim and Amy, thank you so much for joining us.
Thanks for having us.
Yeah, great to be here.
So to start off, Amy, could you help us understand the climate risk that banks are facing today?
Yeah, absolutely. Climate change risks are generally divided into two buckets. There's physical risk and transition risk. Now, I know that bankers are risk experts, but let me parse out the differences here. Physical risks include both acute events like hurricanes and wildfires, and chronic risks like rising sea levels and temperatures. Transition risks stem from policy changes, developments in technology, and changes in market preferences as we transition to a low carbon economy. For example, we've seen a huge market shift towards electric vehicles, and this stems from a few factors. Technology continues to evolve and improve. Buyers are interested in these types of vehicles, and California's regulation will require all new cars sold beginning in 2035 to be zero emission vehicles.
Yeah, exactly. And what's important for banks to note is that climate risk is not a separate new risk category, right? The climate-related financial risks that Amy just mentioned feed into and permeate all of a bank's traditional risk stripes. So this includes market risk, credit risk, operational risk, reputational, and even litigation risk for all you lawyers out there.
That's helpful to translate these climate-related risks into traditional risks that banks are used to managing. So when it comes to these climate-related risks that you just alluded to, how do banks start to measure and assess them?
Great question. So when it comes to physical risk, there are a variety of tools out there that can help banks assess their physical risks. One resource we often point banks to is FEMA's National Risk Index, which is free and publicly accessible. It provides physical risk data at the county level, or even more granularly, at the census tract level. Banks can start to review where their borrowers are located, where key locations of their borrower's supply chain are located, and then assess their borrower's physical risk using this data. Banks may also want to think about their operational risk in terms of their ability to keep their branches open and operating using this data. We've seen bank branches temporarily close in Hawaii due to their wildfires, and a couple of months ago, we saw banks temporarily close in Vermont and other northeastern states due to flooding.
Yeah, exactly. And if you look back, you can find examples of like permanent closures that resulted from climate-related physical risk. So, for example, 2 credit unions in Louisiana, I believe, closed down permanently due to the impact of Hurricane Katrina.
Wow, I didn't know that had happened. So we've really seen financial institutions permanently close due to physical risks, and we're just at the early stages of this. So, but now to talk about transition risks, how should banks go about measuring and monitoring that aspect of climate change?
Yeah, so measuring transition risk is admittedly more difficult because we've never really faced it before, and there's a lot of uncertainty around the timing and severity of its drivers. But when banks are thinking about their transition risk, there's a few sectors that will be more impacted than others. We recommend that banks start their transition risk analysis with those sectors, which include fossil fuels, electricity, energy-intensive manufacturing, transportation, agriculture, and buildings. Banks can identify clients in these sectors using industry codes and then engage those sector clients to figure out if they have credible transition plans and to align with a low carbon world. Banks should also track progress against those transition plans, including by asking clients for emissions data. With these transition risk assessments, banks should be calculating the impact on their credit risk, specifically overall loss calculations made up of estimate changes in probability of default and loss given default. And integrating climate risks into PD and LGD will help ensure that these risks aren't isolated, but instead integrated into the overall risk profile of banks' customers.
Yeah, and another tricky discussion for banks is now that you've engaged your borrowers about transition risk, what can your bank actually do about it, right? So another way of saying it is, how can transition risk be hedged? So we said earlier that devising a strategy for the transition to a low carbon economy didn't require your bank to divest from your high GHG emitting borrowers. And this is true in the immediate term. But what if a bank's client is unable or unwilling to modify their business model to be successful in a low carbon economy? Again, let's say it differently. What if a bank's credit department is of the view that climate-related transition risks will negatively impact that borrower's ability to repay the bank's debt? In such cases, prudent, and this is business as usual risk management we're talking about here. Prudent risk management would require the bank to proactively reduce the credit exposure to such a borrower. And this risk management strategy in the climate space is often referred to as active portfolio management.
Interesting, but maybe I'll play the devil's advocate here for industry, because I see some challenges that for transition risk, some of these high emitting borrowers are also very profitable clients. And on physical risk, banks can't easily just change where they're located. Many of the smallest banks are the ones who are in these areas that if people are in Florida or Texas, they can't move their banks and their clients are located there. So how should they deal with this issue?
Yeah, that's a great point, Matt. And again, I'm a former banker myself, so I have, I can feel for where this question is coming from. So look, as we said earlier, the solution is definitely not, and let me underline not, to abandon these borrowers. Step one is to work with the borrowers to help them develop a viable transition plan. This viable transition plan will be the best hedge against transition risk. Now, we keep saying credible. A credible transition plan, properly executed, will help the business remain successful in a low carbon economy. And incidentally, again, with my banker hat on, the retooling of a borrower's business model will require advice and capital from a bank. So far from being a charitable activity, helping your borrower in this manner will also help your bank's bottom line. And then taking a step back, as everyone listening to this podcast lives in the real world, we all know that for whatever reason, some borrowers will be unable or unwilling to adapt to the transition. In these cases, the best remaining way to deal with the transition risk is to revisit the active portfolio management strategy we mentioned above, or its cousin, managed phase out, if you're dealing with an asset level concern. So to reiterate, implementing an active portfolio management strategy is, again, not a decision to be taken lightly, but it is an effective strategy as a last resort to remove the transition risk from your loan book. We often get asked too, what's the optimal timing to do this? Well, because climate-related financial risk in your portfolio rarely, I don't want to say never, but rarely produces positive outcomes, the longer you leave unhedged transition risk in your loan book, the more you'll suffer negative returns as time progresses. So borrowing from options pricing theory to state this more succinctly, unhedged transition risk has negative time value for your bank. The sooner you get rid of it, the better off your bank will be.
Totally agree, Jim. And for physical risk, banks should be thinking about how to make their communities and their operations more resilient and thinking about how to adapt to climate change. This could mean lending opportunities to make structures more resilient to high winds or raising structures to reduce flood impacts. It could also mean advising mortgage clients on their physical risks and encouraging, or even better, incentivizing them to get flood and earthquake insurance, even when it's not required. Now, when it comes to building new structures or rebuilding damaged structures in high risk areas, we as a society, including banks, really need to consider if that makes sense. Banks shouldn't be alone in this work, though. They should be working with their local, state, and federal governments to support climate resiliency efforts for their communities. And at the end of the day, banks cannot abandon the communities that they serve. The most vulnerable communities to climate change are also the most economically vulnerable communities already. Low and middle income communities are subject to significantly more climate risk than higher income communities. They cannot afford to also lose access to financial services. This does mean that financial institutions serving those communities on average have significantly more physical climate risk too. The NCUA published research a few months ago that showed that just over half of minority depository institutions are at relatively high or very high risk of experiencing negative effects stemming from climate, weather-related, and other natural disasters.
Thanks for that insight on how banks should be working with their high transition risk clients. I think it's helpful, and I think many people on this call or who are listening to this podcast will connect with what you're talking about, Amy. But to shift gears slightly, Jim, I understand that you have an extensive background in derivatives and capital markets from your time at Citibank, and you've written a report on the intersection of climate change and derivatives. I also work with financial institutions on derivatives. They're some of Mayer Brown's largest clients, but I haven't heard as much about the climate change interface here. So why have you focused on derivatives?
Yeah, good question. In addition to being my favorite subject for everyone out there, globally, the OTC derivatives market, I mean, it's monstrous. It stands at around $600 trillion for banks, right? 200 trillion in the US. So to date, however, it's very profitable and it's widely used and it's systemically important. To date, this line of business has been largely absent from the climate risk management conversation in general, so we wanted to put a focus on it.
Well, thanks. That does sound huge, and I really appreciate you giving us some perspective around that size. But why, if the U.S. is 200 of 600 trillion, what kind of concentration is that when I'm thinking about my clients?
Yeah, so the top 5 US banks actually control 95% of the US derivatives market.
Yeah, and you know, to summarize our findings, our report found that if U.S. banks were to include their derivatives activity in their climate disclosure, some banks would see their financed emissions increase, up to 3 times. So putting that into dollar terms, we're talking about an extra trillion, give or take, $1 trillion in climate exposure, and that doesn't include what's in their other business lines like loans, et cetera.
Wow, that's a surprisingly large number. Um, and I guess I'm not surprised, or I am surprised that I haven't been hearing more about this impact on derivatives yet. That I certainly know that climate exposure reporting has been a controversial topic in the U.S., and we really don't yet have government standards around this. I know PCAF, though, they're a private sector organization, the Partnership for Carbon Accounting Financials, and it's seen as a gold standard for bank carbon accounting and guidance on measuring financed emissions so far. Does PCAF have guidance on measuring bank facilitated emissions like bond issuances, and does it extend to things like derivatives?
Yeah, very good question. And I agree with you about PCAF being the gold standard. To be fair to our friends at PCAF, they've had their hands full recently developing guidance for facilitated emissions. So their staff have been working very, very hard on that. But no, currently PCAF has not come out with a view on derivatives. However, our view at Ceres is that, financed emissions should be defined broadly as activities where A, the bank acts as a principal, B, they use their own capital, and C, the activity creates credit risk that the bank retains. So both loans and derivatives fit this category, this description rather, and so we believe derivatives fall squarely into the financed emissions category.
Yeah, and that's in contrast to facilitated emissions, in which the bank acts as agent rather than principal. It doesn't use its own capital, and the activity does not increase bank credit risk. Large sources of facilitated emissions for banks include bond and equity underwriting and M&A advisory services of carbon-intensive businesses.
That sort of makes sense, but when I think of derivatives, I think of the standard form documentation and some really hard math, and so other than maybe a little extra heat coming out of my laptop, how does a derivative contribute to real world greenhouse gas emissions?
That's a great question. I'd be happy to expand on it. The best way to look at this is let's take a look at a few real world examples of how derivatives are used by banks and companies. So as you know, there are obviously many, many types of derivatives that banks provide to their borrowers. One, for example, would be where banks provide their energy consumer borrowers with something like a commodity derivative that provides for the actual delivery of oil or natural gas, let's say, as the underlying commodity at a fixed price. And this is a super useful product. It helps the borrower smooth out price volatility. So it actually has a real practical use. However, here the bank derivative contract actually moves hydrocarbons around so that borrowers can fuel their typically emissions intensive industrial processes. So in this example, I think it's pretty clear where the quote unquote real economy emissions and real economy impact is. Let's move away from kind of the energy sector and consumers. Another relevant example of real economy impact arises when banks use things like credit or equity derivatives to help the investor side of the firm finance investment positions. So here the banks themselves are buying the bonds or the stocks and then entering into a derivative to synthetically transfer the economics of the position to the investor. And again, legal title and cash don't change hands. This is being done through a derivative. In those situations, the underlying bonds or stocks the investors want to invest in are going to be multinationals, large caps, and a lot of those are going to be high emitting issuers. So again, in that circumstance, all road leads to Rome. In this case, I just described, derivatives provide high emitting companies with funding in a way comparable to a bank simply lending them money.
Yeah, and to jump in here, the most common type of derivative, interest rate swaps, they represent about 70% of the $200 trillion US derivatives market. And they've been around for a really long time and are used by borrowers and investors alike. We've seen banks regularly use interest rate swaps to de-risk their corporate financing packages. These derivatives are often so intertwined and interlinked to the loan that they share in the same security package and loan covenants. So here there's a strong case to be made that interest rate derivatives, at the very least, are partially responsible for enabling the direct financing of high emitters, again, establishing a clear link between real economy emissions and a bank's derivatives activity.
Thanks for that detailed overview. And it's actually interesting that I had the opportunity in law school to meet the inventor of the first interest rate swap from the early 1980s. He was retired by then. And just seeing how much it grew, I think it was maybe a net notional 500 million swap to the trillions that we're talking about now on this podcast. I wasn't born when it was invented, but I still am amazed at how quickly it's grown since the 80s. Another topic, though, that comes up often with financial institutions is regulation. More of it may mean more money for me, but obviously it's not good for my clients to just be regulated willy-nilly. So it's about making sure it's the right balance. And on climate-related regulation, there's been some movement for banks recently, but I think it's pretty nuanced. Amy, given your background with the Fed, can you talk about those developments?
Absolutely. So the three federal banking regulators, the Fed, the OCC, and the FDIC, all issued draft principles for managing climate risk for large banks, which they've defined as 100 billion or more in assets. They cover a few topics, including risk governance, strategic planning, risk management, scenario analysis, and how climate feeds into traditional bank risk categories. Given that we've already seen financial institutions fail due to climate change related risks, we really think that these principles are necessary. But all banks, regardless of asset size, need to manage their climate risk, and we would like to see regulators provide more resources and more specific guidance to help them do that, especially for the smaller banks. One issue that the World Bank saw happen in another country that implemented similar climate risk regulation for large banks is the risk just shifted to smaller banks. Large banks offloaded some of their riskier assets to manage their climate risk, but then small banks that were not managing their climate risk just picked up those assets. And this made the small banks even riskier, which is especially problematic given that smaller banks already aren't as diversified.
Exactly. And, it's not just the federal regulators. I mean, Matt, you and I are based in D.C., just up the 95 from us in New York State. The NYDFS recently put out an excellent draft set of climate principles that they expect all of their regulated financial institutions to use as best practices. So what does that mean? Well, they are now expecting GSIBs, local branches of foreign banks, regional banks, and even credit unions to use risk monitoring techniques like climate scenario analysis. And one of the things, by the way, that they did that makes these principles both smart and practical is including this concept of proportionality, meaning, they understand that the cost of compliance doesn't hit everybody equally. So again, they are not expecting small banks to do the same level of quantitative scenario analysis, just to be clear, that a large bank could, given the obvious discrepancy in resources. And for all the regulatory lawyers listening in, this is a great example, at least in our view, of the type of smart regulation that we would love to see more of.
I think we all would love to see that kind of smart regulation around proportionality that for far too many years I've seen these expectations for the GSIBs trickle down in an untailored way to smaller organizations. And I was just at dinner last night with a mortgage banker who was saying, well, look, there's prudential standards where people propose treating mortgage bankers like real commercial banks and like GSIBs, and how are we supposed to, like, we don't carry accounts. And I was like, yeah, I know it's this known problem in the industry, and hopefully we'll get it right next time, and I'm sorry for you. So to talk about scenario analysis of maybe where we can get it right for climate change, how does the Fed's pilot climate scenario analysis fit into this tailored approach?
Yeah, the pilot ran this year with the six largest banks in the US. It asked banks to assess physical risk on their real estate portfolios using two natural disasters with the strength that they would be in 2050. It also asked banks to consider the impact of insurance withdrawal, which we're already seeing happen, unfortunately, especially in California, Florida, and Louisiana, which have lost about a quarter of their insurance companies over the last several years. For transition risk, the pilot asked them to assess impacts on their corporate loans and commercial real estate portfolios over a 10-year period using two scenarios, one that's based on current policies and one that's based on reaching net zero emissions by 2050 using an early and orderly transition scenario, kind of best case scenario for transition risk.
I certainly have heard orderly come before, talking about orderly liquidation authorities for failed banks. And despite the regulators' best efforts, I think the stuff earlier this year was anything but orderly. So we don't always get it right maybe on the first go round. How does this first go round by the US regulators compare with other climate scenario analysis efforts around the world?
Yeah, so in general, it's a less comprehensive exercise than those of other central banks around the world, and even of those that banks have been conducting on their own outside of regulator-driven exercises. Transition risks are generally modeled over a 30-year horizon rather than 10 years, since transition risks are expected to continue to increase until we reach a net zero world. There also isn't a scenario for a delayed and disorderly transition, as we were discussing, which is both the most damaging and the most likely scenario. Physical risk also isn't assessed on banks' corporate loan portfolios and does not capture chronic physical risks in a holistic way, instead focusing on the impact of two large acute physical risks like a hurricane. However, the insurance withdrawal piece was a really important component that we were really happy to see included for banks to consider.
That insurance withdrawal thing is something you've mentioned a few times to me, and that I've heard from NYDFS, from the Fed, and others. And maybe I was jaded at first when it came out of, well, you can always buy insurance from someone, um, and it's just a matter of the right price or the right broker. But it seems like this has been a hot topic lately, so maybe I'm missing something there. Could you speak a little bit more about what's happening and why regulators are so concerned?
Yeah, absolutely, absolutely. I mean, this topic, along with my tips for the Washington Commanders ownership in terms of how to ensure they win the Super Bowl, these are things that I could devote like an entire podcast to. But to cut to the chase, in our view, this is nothing more than an example of what we discussed earlier. The insurance withdrawal, quote unquote, we've been seeing is really an accelerated version of this active portfolio management slash managed phase out strategy in action, but for insurers instead of banks. So insurers, having assessed that the climate related physical risk in certain states will continue to increase, have decided to eliminate the quote unquote negative time value in their portfolio by closing up shop in those states. And obviously, the way it's been done by the insurance industry has serious knock on effects for a large group of stakeholders, including marginalized communities. Uh, in any event, we don't have time to dive into this further today, but the actions taken by the insurance industry should provide some lessons for the banking community on the do's and don'ts of implementing active portfolio management.
Very shocking, and definitely a topic to cover on another podcast. And also good to hear that banks have the chance to be the heroes here. Um, on another topic that I get some calls on as a former CPA, around reporting and disclosures, and specifically things like TCFD and the right types of climate related disclosures that banks should be making. Are you guys involved in this, and do you know who actually uses these disclosures?
Yeah, definitely. So financial institutions have been voluntarily issuing these disclosures called TCFD, or Task Force on Climate Related Financial Disclosures, over the last several years. The disclosures have focused on climate related financial risks posed to the bank and how they're managing those risks. And these are really most useful for banks, investors, and other stakeholders as well.
Yeah, agreed. Agreed. So TCFD-based disclosures have already been broadly adopted by banks, as Amy mentioned. I think the latest number is that some 1,500 financial institutions responsible for something like 220 trillion in assets, some giant number like that, support and use TCFD. And this includes the 30 GSIBs as well as a number of regional and small banks as well. Uh, and also, in a sign of how much momentum TCFD is generating globally, the ISSB, so the International Sustainability Standards Board, just announced that it would be taking over the monitoring and progress of companies' climate-related disclosures from the TCFD. So really solidifying its position as the global gold standard here.
Yeah, that's right. And within the US, we've seen movement too. Aside from the SEC's proposed climate disclosure rule, a few states have been moving too. California appears very close to passing two climate-related disclosure laws for all mid and large-sized companies that have a presence in California. The New York State banking regulator that we mentioned earlier also asked its banks to develop climate-related disclosures and consider the TCFD framework when doing so.
And don't forget our friends in Minnesota. They just passed a law requiring all banks with more than $1 billion in assets to submit an annual climate risk disclosure to their regulator as well.
Yeah, good catch, Jim. And that's separate from regulator expectations. We've seen huge appetite from investors for climate-related disclosures, as I mentioned. The last 2 years have brought record numbers of shareholder resolutions related to climate change, and a portion of them have been related to disclosing climate risks and transition plans.
Well, thank you, Jim and Amy. It's obvious there's a lot of movement in climate risk management from banks that I wasn't even aware of the Minnesota law. So I'm gonna have to open that up, and maybe the listeners will get to see an article coming out on it if it's not enough to write about. But wow, these are really evolving expectations from regulators' risk management principles and these pilot changes on scenario analysis all the way up to the headline politics and investor demand. So I guess as we've learned today, climate change really is not an environmental issue. It's a financial imperative that demands our attention and action from the banking sector. And I'm confident, as they have for hundreds of years, that they will step up to the challenge, that integrating climate risk management strategies not only preserves banking like it has for those hundreds of years, but also contributes to a stable and sustainable global economy. Uh, really appreciate you guys for sharing your insights on climate change risk management. Also, as always, I want to thank our audience for tuning in. Without you, we wouldn't have a reason to do these programs. And so please stay tuned for the next episode.
It was a real pleasure. Thanks, Matt.
Yeah, thanks again, Matt.